This is FRM Part 2, Book 4, Liquidity and Treasury Risk Measurement and Management, and the chapter on the investment function in financial services management. This chapter is taken from a textbook called Bank Management and Financial Services, and one of its authors is an academic, used to be a professor at Old Dominion, so we're used to reading these kinds of chapters. This is a relatively long chapter, over 30 pages, and so our slide deck matches that length. So you might think, you might be tempted to think we've got 50 or 80 learning objectives, but as you'll see, there are just 3 of them. Now, the good news is that these learning objectives are pretty general. And the bad news is that these learning objectives are pretty general. So we're going to compare various money market and capital market instruments. We're going to identify the factors that affect the choice of the investment securities, and that's going to be the bulk of the slide deck. And then at the very end, we'll talk about the yield curve and duration. Now, for some of you, this will probably be a little bit of a review. You know, this chapter could be called something like, here's a chapter on short and long-term fixed income securities that bankers like to invest in. So let's go ahead with some real basic definitions and some differences in these kinds of markets. So money market, what is that? Short-term market, capital market, long-term market. You know, that makes perfect sense. So what kind of a time period are we talking about with short versus long-term? And of course, the classic answer, and this goes back to the accountants and the way they handle, those securities available for sale on the left-hand side of the balance sheet. So we'll do 1 year. And look at the examples. We'll go ahead and talk about treasury bills and commercial paper, low yield and low risk. On the other hand, capital markets have these long-term fixed income securities and equity securities, including stocks and convertible securities. These tend to have greater risks, and we'll talk about all those different kinds of risks, and then a higher yield. And so when these securities are issued by businesses or corporations, then they make up the capital structure on the right-hand side of the balance sheet. Remember, we talked about this at length going all the way back to 1958, and Professors Modigliani and Miller taught us all about capital structure. You know, firms can finance their investment in long-term assets generally in one of 2 ways, either by issuing fixed income securities or by issuing equity. And so that makes up the firm's capital structure. Now, of course, with a bank, that bottom right-hand side of the balance sheet is much lower than for a company like Johnson & Johnson. All right, let's go through a list of some money market instruments here. And maybe I can do this pretty quickly. Hopefully you guys have lots of experience in what these things are. Treasury bills. And so the first question we have to ask ourselves is, why in the world is the federal government in the United States borrowing money? And the answer to that question very quickly is that, all governments do 2 things. They tax and they spend. And when those 2 things are identical, that's called a balanced budget. But as you know, rarely are those 2 things equal. The spending seems to be greater than the taxing. And so you have to finance it. And so in the United States, the federal government issues treasury notes and bills, long term. We'll talk about those in a little bit. But treasury bills in the short term. And treasury bills can mature in increments. It's usually 1, 3, 6, even 9 months. But they're less than a year. And these are known as discount securities because they pay no coupon. They pay no explicit form of interest. So if a treasury bill matures in 6 months for $10,000, then you're probably willing to lend the U.S. federal government something less than $10,000. So they'll always sell for a discount. The chapter really emphasizes these advantages and disadvantages, and I probably would know those things, although some of them are self-evident. So what's safe, liquid, used as collateral? What don't we like about them? Low yields. In fact, as I'm speaking here at the end of the summer of 2020, the yields on every Treasury security, with the exception of the 30-year Treasury bill, is less than 1%. money market instruments also include these longer-term Treasury notes and Treasury bonds, but only when they have 1 year or less to mature. So think about it. Treasury note, 10 years, Treasury bond, 30 years. Sooner or later, they're going to get within 1 year of their maturity dates. And so they are considered to be money market instruments, even though they might still have one or perhaps two final coupon payments to make. One of the interesting things about holding these long-term securities as they mature, so they are money market securities, is that because of that coupon, they're much more sensitive to interest rate changes. And, if I do this with my hand, there's about this many Treasury bills out there, and there's only about this many Treasury notes and Treasury bonds out there. So they're probably less marketable, maybe a little bit less liquid. But they still enjoy a high degree of liquidity, as shown by the advantages there. They do offer the potential for capital gains if during that time period interest rates fall and then the price can rise. How about short-term securities that are issued by the various federal agencies? Now, of course, these are ones that mature, within a year. And we have all these federal agencies like the Federal National Mortgage Association. So say those first four letters fast: FNMA, FNMA. So that's Fannie Mae. There's also Farm Credit System. There's Federal Land Banks, and then there's Freddie Mac. So we have all these, kind of names for these federal agencies that issue bonds and notes, and they use the proceeds to kind of support a particular market, like the farmers, like homeowners. There, Fannie Mae. There's also one that supports student loans. So that's Sallie Mae, Student Loan Marketing Association. So look at the advantages and disadvantages. Secure, relatively good liquidity. I remember there's a lot of these things out there. Good collateral, but they are not considered to be default risk-free like U.S. Treasury securities are. So they offer higher yields. Now, I could do a comma here, and we could have a debate for maybe the next 10 hours. Are these securities truly perceived to be default risk-free? Some people would say yes. Lots of people would say no. Who knows really what the answer is until one of these things defaults, and then we'll see what the federal government does. Yes, look at some of the disadvantages. These things are taxable, and they are less marketable, even though there are lots of them. Remember now, so if you got the Treasury market that's this big, you might have the Fannie Mae market that's this big. So there are fewer of them out there, so they have to be less marketable. CDs, these are probably an obvious notion. I'm guessing that lots of you have invested in a certificate of deposit during your lifetime. And so what are these things? These are issued by a depository institution just to raise funds. And what these institutions try to do is lock up that capital for 3 months or 6 months or 9 months so that they don't have to worry about depositors coming in and withdrawing their money every single day. They know that they'll have a fixed percentage of those certificates of deposit available for loans. So they do offer higher yields, and they are pretty liquid. The income is taxable, and then there's not much of a secondary market. Some, but not much. Commercial paper is kind of the corporate analog to Treasury bills. So notice that first block point, equivalent to Treasury bills. Kind of equivalent, but they're not perfectly equal. Treasuries. I mean, the Treasury Department, they issue, typically 30, 60, 90 days, but they could do 23 days or 45 days. They could do anything. But because of SEC rules, commercial paper typically has a maturity of 270 days because of registration and all sorts of different things. Although corporations can issue commercial paper with any maturities, and so the textbook mentions, 1 month, 3 months, 6 months, etc. These things are issued by large corporations to manage their working capital needs, because what happens, cash flows for a business, they go like this. So when they're down like here and cash flows are way down low, well, a large company like Procter & Gamble is not going to say, okay, we're insolvent, we can't pay our bills. It's really not that big of a deal. They just issue tons of commercial paper and then they repay it when the cash flows are up here. Yeah, low risk, although it's no risk. These are discount securities, so they'll sell for less than their maturity value. Lots of these are issued in increments of $1 million, subject to tax, and they are riskier, and commercial paper is graded by the ratings agencies. How about an international euro currency deposit? And so this is a kind of a general name to reflect the simple fact that businesses are global and they generate cash flows in all different sorts of currencies. And so if they deposit one currency in a different country with a different currency, then it's automatically called euro currency. So don't let the term euro mislead you into thinking that it has to be the euro. It could be any currency deposited anywhere outside of the domestic currency. These things are probably not insured. They're probably not even secured, so they have higher yields. But they have wide ranges of interest rates throughout the world. As you can imagine, different economies are going like this and like this. And then, of course, the income is taxable. Banker's acceptance is one of my favorite securities out there because it's the result of international trade. And so what happens to facilitate trade is that between and among countries is that you need a bank to step in. And a bank steps in and guarantees the payment. They say, yep, this person over here in Europe, we promise to pay their liability to you over there in Canada. And we'll do that in 10 days or 30 days or 45 days, whatever it is. And so this facilitates international trade. And so the exporter has a bank guarantee, and they might not want to wait 15 or 30 days, so they can sell it. And when they sell it, it becomes a banker's acceptance. And there's a huge secondary market for banker's acceptance. So low risk, multiple credit guarantees. The banks all over the world do this. Limited availability at specific maturity. So remember that this is the result. The banker's acceptance is the result of a particular trade. So if I'm here in Pennsylvania and I want to buy chocolate that's made in Germany, I have to go to a bank and say, okay, I'm buying, how about if I make this up? I don't know, 1,000 pounds of chocolate, whatever that is, for a certain number of euros. So the banker's acceptance is tailored to that particular trade. And so it's not standardized. So that's pretty much the disadvantage. So look, limited availability at maturities, odd denominations, not odd because I'm odd, but odd because it's not standardized, and of course taxable. Municipalities, they also issue short-term obligations. I mean, they do long-term obligations a lot of times, but they do short-term obligations, and this is very similar to commercial paper for large corporations, because what do we know about a corporation, right? Its cash flows go like this, they go like this, right? But what about the cash flows for a municipality? It is the fall of 2020 here as I make this recording, and I have to pay my property taxes. So the municipality is going to pay is going to accept school taxes from me and all the thousands of other people. So there's going to be a giant influx of cash flow. But the municipality still had its obligations, let's say, April and May and June and July and August. So they issue this tax anticipation note or revenue anticipation note, knowing that we're going to pay our property taxes and our school taxes. Tax-exempt income, of course, just like long-term municipal securities. Limited resale, capital gains may be taxable. So you see the theme here for advantages and disadvantages is one of taxability and liquidity. All right, so that finishes our discussion on money markets, right? Let me go back here, make sure you see that heading. So let's go to capital market investment. So we've already talked about treasuries. Let me just go back quickly and remind you that the U.S. federal government has a budget deficit. So it issues treasury notes and treasury bonds. And remember, Treasury Department could issue these things over any maturities, but mostly Treasury notes are 10 years, mostly Treasury bonds are 30 years. Of course, they have a higher yield than Treasury bills for a number of reasons. We'll talk about the risks here in just a second, but one simple reason is that it's just longer term. They're very secure, tremendous secondary. I mean, remember, as of 2020, the U.S. federal government has issued about $28 trillion in these bills and notes and bonds. So as you can imagine, thriving secondary market. I mean, exceedingly thriving secondary market because there's so many of them out there, and there's a tremendous demand because they are default risk-free, can be used as collateral. Of course, they have less risk, so they're going to have lower return. There's another disadvantage, a tax disadvantage. And then here's one that we haven't worried too much about. In the short term, if you have a security for 30 days, you're not too worried, at least here in the United States, you're not too worried about inflation. Because inflation, even in its days of the late 70s and 1980s, when inflation was high, it wasn't as high as other countries have experienced, like 50% or 100% or even 1,000%. I think the highest inflation rate during my lifetime, and I am in my 60th year of my life, was somewhere around 14 or 15% back in the Jimmy Carter to Ronald Reagan years. But inflation risk is a tremendous risk when we're considering over the long term, because you'd hate to get a coupon payment of, let's say, $100 from a treasury bond, and you were going to pay your monthly electric bill with that coupon payment, and energy prices have skyrocketed, and so you can only pay half your bill or a third of your bill or an eighth of your bill. Here are the municipal bonds, state and local government bonds. Why do local governments issue bonds? Same reason that federal governments do. They have a budget deficit, and the budget deficit is typically not in the general operating budget, but in the extra stuff that it wants to do, like build a new school system, build a road, college dorms. So there are generally two types of bonds. These are revenue bonds, which are issued to finance specific revenue generating projects like a toll road, like a bridge that you have to pay for to drive over, or a tunnel. And so those bonds are then repaid by the tolls, right? General obligation bonds, and these things have tons and tons of applications. These are for general uses, and that's pretty much for, schools and non-toll roads, college dorms. And then, under that revenue bonds, you would probably see a kind of a subcategory in there. I learned them as being called industrial development bonds, and therefore, airports and hospitals and all sorts of things that are going to generate some kind of revenue. Now, it's not specific revenue like a toll, but the economists call that economic rent. All right, advantages. So here's the big advantage. This is why they're so popular. They're exempt from U.S. federal income tax, and they're pretty secure, even though they are graded by Moody's, Standard & Poor's, and Fitch. And some of these municipalities have defaulted over the years. One side note here. This is probably not too relevant for your exam, but if you're living in Arkansas and you buy an Arkansas state bond, you don't have to pay federal income tax, and you don't have to pay Arkansas state income tax. That was a bad example. I use it because my wife is from Arkansas, but I don't think Arkansas has a state income tax. But disadvantages: capital gains are fully taxable, and they're often not very liquid. And so we get into this problem because even though the municipal bond market is large in and of itself, each individual municipality is kind of like its own unique pot. And so there can be a lack of liquidity in that pot, even though there's probably general high liquidity in the municipal bond market. But specifically to each locality, there can be problems in liquidity. Corporate bonds, of course, issued by corporations to fund the investment in long-term assets. Usually the coupons are paid semi-annually. They can be for 10 or 20 or 30 years. They can be 50 years. Walt Disney issued a 100-year bond back in the late 1990s. It's still around, so what does that make it? It makes it an 80-year bond now. And how are these things repaid? Now remember, these are non-amortized loans. So the bondholders receive just interest over the life of the bond, and then they receive their maturity value or the par value of the bond at maturity. Advantages. So these are attractive to lots and lots of people, but especially specific financial institutions like a pension fund or an insurance company or financial institutions kind of in general, because they can have higher credit risk. I mean, of course, they'll have higher credit risk than Treasury securities, but they'll offer higher yields. And so this is where we have to go through the spectrum of from a AAA rated bond all the way down to a bond that is in default. And so each financial institution has to make a decision. All right, what credit risk are we willing to accept? And some institutions, and of course lots of pension funds, have some kind of a rule that says something like, hey, you know what, if it's not investment grade, we don't want it. Disadvantages, here we get into this issue of liquidity. And then we've got these spreads. And so we've talked at length in the past about credit spreads. You know, sometimes they narrow. That's probably an okay thing, but sometimes they widen. And that's probably not a good thing, because widening spreads has lots of implications for things like not only just credit risk, but for the wider economy as well. Structured notes, these are really cool things. What the textbook describes is mostly with these federal agency securities that we talked about before, you know, Freddie Mac and Fannie Mae and Sallie Mae. And so what happened, but they don't have to be federal agency securities. It can just be any kind of a debt security out there. So, you know, you take this pool of funds and you invest it somewhere else. And so notice that second block point, have yields that can be reset based on changes in a reference rate. Could be US bond rate, but could be S&P 500 return. Could have a cap, could have a floor. I mean, lots of these structured notes, in fact, I think they're called structured notes because they have some kind of an embedded derivative in them. You know, the easiest thing to think of for a structured note is that, you know, I could be Jim and I could issue a bond and I could say, hey, I'm going to issue a bond, send me all your money, and I'll give you a certificate that says you own Jim's bond. And what I'm going to do is I'm going to take your money and I'm going to invest it in the S&P 500 index. And if the S&P 500 index does really well, I'll pay you a really high reference rate. If it does poorly, then I'm not going to pay you anything, and then the value of your pool of funds can go down. And there can be caps and floors, and there can be all kind of swap arrangements inside of these things. You know, advantages. All right, so reflection of changes in interest rates are going to determine what that coupon is going to be. And notice that second circle point, so a step-up provision. So there's kind of an embedded, kind of a quasi-derivative in there so that you can get additional yield. But look at the final circle point down there. More complex than bonds, and the potential for large losses exists. So think about this. If I take all your money and I invest it in gold futures contracts, and the price of gold, and I take the long position in gold futures contracts, and I'm convinced the price of gold is going to go way up, but instead the price of gold goes down to zero. Well, I look at you and you look at me, and we have nothing. Large potential losses. Securitized assets, of course, mortgages, credit cards, corporate loans, automobile loans, lines of credit. I mean, financial institutions, they can put all these things together and then issue a bond based on those assets that are now securitized. And so, of course, they're going to have, in general, higher yields compared to that treasury market. But the yields on these things, this is why I like these so much, is going to depend on, well, let's face it, the mortgage market or the credit card market or the automobile loan market. Highly marketable, right? This financial institutions are loaded with these things on their balance sheets. They may come with guarantees from private entities of government agencies. All right, so that's an interesting little kind of an add-on that we don't see in these other securities. Structure may be opaque, right? It might not be easy to establish true credit quality. All right, so I issue this bond based on mortgages. So I chop this mortgage up to a couple of different tranches, right? That's the French word for slice. And so the first tranche, and remember, I'm Jim, so I can write anything I want. So I'm going to say, okay, the first tranche gets paid only if the people who live on Pine Street make their payments on time. Of course, this would never appear in one of these prospectuses, but let's just suppose it does. So that tranche then is unique to the people who live on Pine Street. And if all of those people decide not to pay, then the value of that tranche goes way down. But then it doesn't affect the value of all the other tranches because maybe the people living in the surrounding areas, maybe they pay all their mortgages on time. So it may not be easy to establish the true credit quality of the product. That's why, what do I tell you guys? We need to identify the risk. So when we're identifying the risk, when financial institutions buy these securities, they need to read the terms and they need to evaluate the implications of the terms. I mean, if it says right in there, Jim's first tranche, Pine Street, well, then as an investor, we need to go and look at what's on Pine Street and see who all these people are. Do they have jobs? What kind of assets, et cetera, et cetera. And that leads right into strip securities. And so what I can do is I can break these into, hey, just principal only. I can make them into interest only, and then I can market it, that tranche or that stripping to particular types of investors. Some investors like interest payments. Some investors like just principal payments. And so when you have these different kinds of strippings, there can be no reinvestment risk, and you know what you get, right? Yeah, there's a little bit less of a secondary market, so there's another liquidity issue. All right, how about if we look at that second? Boy, what did I say to you earlier? That was a long first, very general learning objective. So how about the second one? All right, so we're a financial institution. We're trying to figure out which of all that groups of securities that we just talked about, what do we want to buy? What's good for our particular financial institution? So the first thing we're going to do is look at the yield to maturity on a bond. So the yield to maturity, by definition, is the required or the expected rate of return on the bond. I mean, this is how I define this in my classes to my undergraduates, and I'll do the same to you because I think it works well. You guys are all the bondholders, and I'm a big publicly held corporation, and I issue a bond, and I say, here's the coupon rate, 10%, it's 30 years. And you guys get together and you wag your finger at me. You say, look, Jim, we're only going to lend you this money if you pay us 10.5%. Yield to maturity on the bond is 10.5%. That's like the lending cost, right? The lending rate. I have to pay you 10.5%, even though I'm only offering you 10% coupon rate. Well, that, of course, means you're going to pay less for the bond. But you wag your finger and you say, look, Jim, you're not having my money unless you pay me my required return. Now, once I issue the bond to you guys, I raise the capital and then I go invest in this new product line. I promise to pay you, 10% coupon rate. So you're expecting to get, let's say, $50 every 6 months or just $100 a year, whatever it is. Well, you need to worry about, and of course I do too, but you need to worry about yields changing. And this is called interest rate risk. When interest rates go way up, price of your bonds go down. When interest rates go down, when yields go down, then the price goes up. And so this fluctuating bond price is based entirely on changes in the yield on that particular security. Now, of course, the changes in the yield depend on lots and lots of different things. We'll talk about that in just a few moments. But notice the two circle points there. This is important here. Rising interest rates increase the demand for loanable funds by institutions, but falling interest rates decrease the demand for loans among consumers. All right, so interest rate risk, when interest rates go up, there are consequences. When interest rates go down, there are consequences. Some of these are good, some of these are not so good. How about credit risk? Of course, historically, we would like to rely on Moody's or Standard & Poor's and Fitch to go ahead and give us a rating. And so we just go and look at the rating. If it's BBB or above, we call those investment grade. And we think, okay, these are the safest bonds out there. We have a very high probability of getting repaid over 10 or 20 or 50 or even 80 years for that Walt Disney bond. However, we know that these ratings institutions have made mistakes. So we need to do a little bit more of research on our own. And one of the great innovations in the last, 30 years or so is the existence of these credit default swaps. And so you can actually look in the credit default swap market to see how credit risk is being currently priced in the market. Look at that second block point there. Regulatory controls prohibits the acquisition of speculative securities. This is what I was saying earlier about a lot of pension funds and financial institutions have boards of directors that say, you know what, C-rated bond, might be a great company, might be on the way back, but call us if it ever hits a BBB rating. Business risk. This is what I like to think of business risk. I tell my students this all the time. What do economies do? Economies go like this and economies go like that. And so when the economies are expanding, there are more positive net present value projects out there. When the economy is contracting, there are fewer. And so an economic contraction, that's kind of summarized in this concept of business risk. So what does that circle point read? Falling business sales, rising bankruptcies, rising unemployment, and you could throw a bunch of other things in there as well. Liquidity risk. We've talked about this in the advantages and disadvantages. Liquidity risk, really, remember this concept of liquidity is how quickly can you turn your assets into cash to meet those liabilities that are coming due. And so financial institutions, just like the regular old traditional commercial bank, which accepts deposits and makes loans, so deposit-taking banks are especially vulnerable to liquidity risk. And then call risk refers specifically to those bonds that have a call option embedded in them, which gives the corporation the right, but not the obligation, to force the bondholders to sell the bonds back to the issuer at the par value. And so when is this going to happen? Of course, this is going to happen when interest rates fall. So when interest rates fall, what did I just say? Price of the bond goes up. So let's suppose interest rates fall by a dramatic amount. And so the price of the bond is now, say, $1,300 based on $1,000 par value, $1,300. But if that bond has a call option embedded in it, well, the issuer only owes the bondholders $1,000. So when the interest rates fall and that price of a non-callable bond might be $1,300. The price of the callable bond is going to hit a ceiling, right? It's going to hit that. That's why you have that changing convexity. Hits the ceiling. So the corporation is going to call the bonds and they're going to say, look, all I owe you is $1,000. Here's your $1,000. So of course, the callable bondholders are aware that they're going to be out of luck if the bond is called. So of course they pay less for the bond at issuance, meaning that they charge a higher yield to maturity. Let's get back to the wagging of the finger. They say, aha, I see there's a call option in this bond. I was going to pay $931 for this bond, but now that I read that call option, I'm only paying $846. I made those two numbers up. So callable bonds, tend to sell for lower prices because they increase the risk of being called when interest rates fall. Inflation risk. This is really a cool thing. I always give the example, perhaps you guys remember this from a previous recording. If you have a loaf of bread that costs $1 today, and next year you don't know what that loaf of bread is going to cost, right? Let's just suppose that you think it's going to cost $1.10. Well, you could take that dollar and invest it in a financial institution. And if the financial institution, let's just say for some crazy reason, offers you 50%. So you're probably going to invest that dollar. And then a year from now, you'll have $1.50. And if a loaf of bread only costs $1.10, you'll buy the loaf of bread and you'll have an extra 40 cents, right? That's called the real return. But what happens if those two are flipped, right? And you only get $1.10 from your investment, but a loaf of bread costs $1.50. Well, you're worse off than you were a year ago. So that's inflation risk. That's why that first circle point, the possibility that the purchasing power of both the interest income, all right, so you're getting these coupon payments every year, and the repaid principal will be eroded by rising prices. So whenever you think of inflation risk, just think of the price of a loaf of bread. It's $1 today, and if it's $1.06 or $1.07 or $1.10 next year, you can probably deal with that, right? But if it's going to be $2, well, oh my gosh, then how do you deal with your investment in fixed income securities? Look at that indented one. Securities with a fixed rate of interest are hardest hit. Now, those securities that have variable interest rates, and shorter maturities, they have some protection against inflation risk because these coupons are reset every year, and you would think that coupon reset would reflect the level of inflation. Prepayment risk, this is really a cool risk because lots of homeowners, including me, during my lifetime, my wife and I we've owned 3 homes, and we have refinanced our mortgage 3 times during our 30 years of marriage when interest rates have fallen. My daughter, in fact, has just gone through the refinancing process, and she did this as well. So of course, this is good for me and my daughter and for you guys, right? Because we lower our monthly payment. But then notice that if you are the bond holder, then you get the principal amount. Let's just say it's $100,000. So now you have to reinvest that $100,000 at the lower interest rate. That's called reinvestment risk. How about pledging requirements? We've talked about collateral many times throughout some recent videos. Any legal or bureaucratic requirement that securities pledged as collateral or other specific deposits. Depository institutions, they reject deposits all the time until some acceptable collateral is posted. How about tax-exempt securities? So factors that affect the choice of investment. It's one thing to say, oh, hey, this security is going to give me 20%. But if I have to pay 100% of any income that I get as a tax liability, well, then I'm not getting anything, right? So it makes perfect sense then to evaluate these investments on an after-tax investment. On an after-tax basis. And so these of course apply to the municipal securities. Look at that circle point there, and this is probably a really good sentence for me to read because this is likely one of those choices in a multiple choice exam or an essay question that kind of leads you to give the incorrect answer. Only tax-exempt institutions will not evaluate the tax implications like a credit union or a mutual fund. All right, so remember that. Look at the example here. Let's compare 2 bonds. Corporate bond, yield to maturity of 10, tax-exempt municipal with the yield to maturity of 8. So upon first glance, what do we think? Oh, we'd much rather have 10 than 8. But remember that those tax-exempt municipal bonds means that when you receive those interest payments, you can just celebrate and say, dear IRS, I don't have to report this to you. So the after-tax yield to maturity on the corporate bond is only 7%, while it remains at 8%. So what appears to be a superior corporate bond on first glance is in fact an inferior after-tax evaluation when compared to a municipal bond. Now, of course, when I go back up to that example, what I'm assuming in there is that the corporate bond and the municipal bond have, boy, do I want to say similar credit ratings? Now, all the way back during the Ronald Reagan years, Tax Reform Act of 1986, there were a couple of provisions in there that that resulted in a little bit of a change in demand for municipal bonds. And so there were two items that the Congress back in 1986 decided to pass as a law. So look at the Roman numeral 1 and 2. Issues that are no more than 10 million of tax-exempt bonds during a calendar year, and they have to be issued for public purposes. And if that is true, then they become bank qualified. And so what that means then is that 80% of the interest is tax deductible. Now, because of this new change in the tax law, there's probably a different way to calculate after-tax returns. And so it'd probably be a good idea for you to memorize these two formulas. So net after-tax return on municipals is equal to the nominal return minus some kind of interest expense, plus this qualified bond tax advantage. Now, to compute that tax advantage, we need that box down there in the vanilla color. And so all we're going to do is take the product of a couple of different accounts: interest expense, the tax rate, and then the percentage of interest that is tax deductible, which, what did we say back here? 80%. So here's just a quick example. A municipal bond, 10% nominal rate of return, borrowing cost of 5. So what would you think? You would think, okay, 10 minus 5 is a 5% kind of an after or a net. What are we calling this? A net return, but we need to consider the taxability of this. And so look down at the solution in the bottom. There's the 10% minus the 5%, but then we need to add in this tax advantage. So we're going to take 35%, which is the tax rate, times the 80%. And let me just go back here and show you this again. This is 80% of the interest incurred is tax deductible. So we get that 80%, and there's the borrowing cost. So their net after-tax return, the net after-tax return, 6.4%. And so I would just be careful to make certain on an exam that you read the question. If you're given, where am I here? Look at the bottom here. If you're given just, 2 yields and a tax rate, you'll probably use this. But if you're given some extra information like a borrowing cost, then you'll probably use this. And I'm guessing you'll have to memorize that 80%. But that should be an easy number to memorize. How about tax swapping? This is an innovation in which what a financial institution or any kind of an investor does is that they bought high and sold low. All right, so what they do is they go ahead and execute that trade, selling that long position, and so they'll have a capital loss. So they take the proceeds of that and invest in some other company that, boy, looks an awful lot like that first company, right? So the bonds might have similar coupon rates, similar yield to maturity, similar maturity dates, similar credit risk, maybe similar duration, maybe similar liquidity. And so what this allows the investor to do is to reduce the tax liability, but not violating that wash sale rule. So this is particularly attractive to higher tax brackets, right? Tax shifting, this is very different from tax swapping. We're just going to shift portfolios to bring in higher yield securities. Hopefully those higher yield securities are going to be selling at a lower price, but in relation to those older security holdings, they're probably going to be below that market level. Probably, but not always. And so, there's a strategy to find those securities that will help us benefit from tax shifting. How about investment maturity strategies. Let's close our eyes and go back to that concept, asset liability management, right? ALM. So we got these assets over here and we got the liabilities coming due. So it makes perfect sense. It makes perfect sense to, when the liability comes due, we just have a bond that pays off so that we can match that liability. So how are we going to do this? Well, one way is to execute this ladder strategy. So just think about it. You climb up the ladder, and every time you put your hand up there to climb up another rung, that means a liability is coming due, and you bring your other hand up, and there's an asset that is maturing, and so you just you bang those two together. So what does that circle point say? Laddering, because each maturity date represents a rung on the investment maturity ladder. The advantage here, asset liability management. So you got the assets and the liabilities maturing at the same time, so you don't really have to worry a whole lot about interest rate fluctuations. However, when interest rates fall, you probably would rather have a long-term bond as part of the assets so that you can realize that capital gain. How about a front-end load or a back-end loan? So really, you just pile things up on one end. You have lots of short maturities or you have long maturities. And of course, the advantages and disadvantages are that this makes explicit that this is a bet. If you're piling up on short-term maturities, what you're doing is protecting against a spike in interest rates, because shorter-term maturities are going to have shorter duration, and so the value of those assets will fall by smaller amounts, right? And just the opposite if you're back-ended. Now, a popular strategy is the barbell strategy, where, let me go back here real quick, where we combine front end and back end, and we say, you know what, we don't want one or the other. Let's go ahead and try to figure out a common middle ground. So there's the barbell. So we have short maturities and we have long maturities. And so what this helps to do is provide protection against liquidity issues, and it provides the possibility of capital gains. How about a rate expectations approach? Boy, let's go ahead and scratch our heads and say, okay, even great economists like Thomas Sowell and Milton Friedman have made comments. And I encourage you to go read some of their quotes, because these two guys, clearly they're highly skilled and highly intellectual, but they have a sense of humor about them. Rate expectations approach. All right, so if we knew that interest rates are going to rise, then we would stay away from long term. If we knew that interest rates were fall, then we would load up on long term. So the old Thomas Sowell and Milton Friedman reference is that, economists are right about half the time. Sometimes rates go up, sometimes rates go down. But if you have compelling reasons to believe that rates are going to fall or rise, then you can use this rate expectations approach. So let me emphasize, compelling reasons. And when I say compelling reasons, I don't mean that you wake up and say, oh, you know what, I think the economy is due to expand and interest rates are going to go up. I mean, all sorts of research that you've learned in your economics classes, in your finance classes, and in your stats classes. So you can use all of these quantitative tools to be able to predict future interest rates. How about maturity management tools? So remember, as a financial institution and an investor in general, we have a choice. We could pick a 1-year bond or a 10-year bond or a 30-year bond or an 80-year bond. Well, how do we deal with this? Well, one way is to look at the yield curve. So the yield curve is nothing more than a picture of the relationship between time to maturity on the horizontal axis and yield to maturity on the vertical axis. And in general, yield curves are upward sloping. And an upward sloping yield curve tends to mean that the investors, at least in the fixed income market, expect the economy to expand. But yield curves, they change all the time. Sometimes they're upward sloping, sometimes they're upward sloping, and then downward sloping, and then upward sloping. And sometimes they're downward sloping, and sometimes they're flat. There have been crazy yield curves throughout the decades of our country. And so this is why we need to rely on economists and their models to help us manage what yield curves look like and what they mean. One way to do all that is to look at the duration of a bond. So duration, the most important thing to remember about duration is that it is a measure of interest rate risk. Longer term bonds will have higher durations. Shorter term bonds will have lower durations, which means longer term bonds have higher interest rate risk. Now, the computation of duration is not a very easy one. I mean, it's really easy if you have Excel, but it's even easier if you go to, I think Investopedia has a good duration calculator, and you just enter yield, coupon, and time to maturity, and it gives it to you instantaneously. That's how I always tell my students to do it. But it really is a weighted average measure of the time period until the bond matures. So a 10-year bond that has coupons might have a duration of 6 years or 7 years, which means, and I always tell my students this, that even though it's a 10-year bond, investors expect to get their money back after 6 or 7 years. And so duration management, I mean, we could have an entire semester's class on interest rate risk, and it really is lots and lots of fascinating stuff. Let me stay here for a second. One of the disappointments I had in reading this chapter was that there was no mention of convexity. Duration is the first derivative of the price-yield relationship, and convexity is the second derivative. So duration is going to be a line, and convexity is going to be the curvature on that line. And so for longer-term bonds, they might have lots of convexity that will increase interest rate risk. But that's good news for you guys that at least in this chapter, you don't need to worry about convexity. But here's what you need to worry about. And this really summarizes that final learning objective. Here's the bottom line. Are you ready for this? If you have, for some reason, if you know that you have a liability that is due in 5 years, you might be tempted to buy a 5-year bond. And that makes perfect kind of common sense outside of any investment and economic knowledge. You would think that, okay, that bond that matures in 5 years, I'll take that principal payment and all the coupon payments and I'll pay off that liability. But it doesn't work that way, because you're going to receive those coupon payments during that 5-year period. And what are you going to do? You're going to reinvest them at the prevailing rate. Well, if interest rates fall, let's just suppose they fall to 0 and you reinvest those at a 0% interest rate, then you're not going to get any compounded interest on that future value, and you're going to fall short of being able to pay that liability. So what you do is you buy, and I'm making this up, you buy an 8-year bond that has a duration of 5 years. So that's what that first block point means. Immunization is a risk mitigating strategy that matches the duration of assets and liabilities. So to immunize a portfolio, what you do is you buy a bond that has a duration equal to the investment horizon of the liability. That way, whether interest rates go way up or interest rates go way down, you will have enough to meet that liability. All right, so notice the circle point. It reduces an institution's exposure to interest rate risk. What I would love to say is that it completely eliminates interest rate risk, but it doesn't. Unfortunately, it does not. And this is because duration and convexity, but let's just talk about duration here. The duration of a bond changes over time with the yield and with the shortening decay of that maturity date. So what looks like a good immunization strategy today might be terrible 2 years from today. So you need to have dynamic hedging in order to fully immunize a portfolio. And if this were an investments class, I would love to be able to talk to you for the next 6 hours on how this is possible. But the important thing is, let me go back here, duration is a measure of interest rate risk. Okay, that's important. Second thing is that you can immunize a portfolio by matching the investment horizon to the duration of a bond. And please remember not to check the mark on the exam that reads, it completely eliminates interest rate risk, because it doesn't. It reduces the institution's exposure to interest rate risk. And that was a long recording for a long chapter for only 3 learning objectives. And so once again, I love all of this material, and I'm going to just suggest that you love it too. So know all that stuff that we talked about today.